stagflation environments are not great for many types of stocks because they have margin pressure, whereas gold and silver, they don't have profit margins, right? They're scarce stores of value. And so that's the type of environment. A stagflation environment is where you generally get the biggest gap. That's my base case. Yeah, basically, they have a clear set of mandates, which is, price stability that they define as 2%, the way they measure it for what that's worth, and then also, maximum employment. And right now, with official unemployment pretty low and the official CPI and PCE pretty high, they have a clear credibility problem, and so they're going to try to tighten until something breaks. It's funny if you phrase it a certain way. I mean, basically, when unemployment's low, their mandate is to increase unemployment, and when inflation is below their target, their mandate is to devalue currency faster. It's
Yeah.
kind of funny when you phrase it like that, but basically, they're clearly in right now the mode where they want to increase unemployment in order to take some slack out of the demand side because they can't do much about the supply side. They have no they don't the Federal Reserve doesn't have stockpiles of oil and chips and logistics and copper and things like that. And so the best they can do is try to rein in demand around the margins.
So do you think it's a political pressure right now? Right now, the political pressure is all 100% on, reigning inflation. And at some point, as the numbers get progressively worse, whether it's mortgage refis or the housing market or anything, does the political pressure then shift to save the economy at some point and then ignore inflation? Or do they have to go the Paul Volcker route of we've got to stop inflation no matter what?
I think the former. I think they're going to basically shift focus, right? So right now, people, if they want a job, it's fairly straightforward to get a job, and the clear problem that people are facing is inflation. That's what if you poll Americans, what's the biggest concern? Inflation is near the top of the list, and so they have a pretty clear mandate to fight that. I think it's like a dog chasing a car, though. They don't know what to do once they catch it, right? So if you increase, if you reduce demand, that's another way of saying a recession, at least a mild recession.
Yeah.
And so to the extent that they succeed in taming prices, that's not popular either. That's why there's something called the misery index, which is basically the combination of unemployment and inflation. And so you're basically, I think, just shifting from one side to the other side, because the ultimate problem is the supply side, right? So we've kind of have malinvestment and underinvestment in a number of areas. And so until we get more energy supply online, until we get logistics sorted out, you're kind of stuck between, you know, inflation or stagflation, right? So you can print a lot of money and give it to people, but that'll, you'll get currency devaluation, or you can try to tighten demand, but then you get a recession, because the supply side's still tight. And so, as soon as they start stimulating again, I think you're gonna, you'd come out of this, if they manage to plateau prices for a period of time due to sinking demand, as soon as they're forced to re-stimulate, I think you'd see, another round of price increases and currency devaluation. What makes it different from the 1970s Volcker era is that debt as a percentage of GDP is so high that, we've kind of extended this for so many decades that there's not a lot of leeway left. They're kind of stuck between currency devaluation or, kind of economic collapse, or kind of deflationary collapse until we see what's on the other side.
Do a lot of we're obviously Wall Street silver and we care about silver and gold markets here. And a lot of our people, our audience is waiting for that pivot. We think that as soon as the Fed makes that pause in raising interest rates and maybe pivots back to lower rates, that might be the trigger for gold and silver to finally launch to new all-time highs. Have you given any thought to that, or in terms of what might be the next trigger for the gold and silver markets?
I think so. I think basically we've been in this environment of, at least relatively speaking, a strong dollar. The market, the funny thing is the Federal Reserve has lost a lot of credibility, but the market still seemed to think they're going to keep tightening policy. I think a lot of economists and banks and analysts and things like that, their models only go back a few decades. And so they say, look, there's inflation. They have to tighten until there's not inflation anymore. So of course they're going to do that. Whereas they don't look back further to the last time sovereign debts and overall debt as a percentage of GDP, public and private, were this high, and they don't run the math on, what does positive real rates mean when debt levels are this high. And so I think that, the Fed's going to tighten until something breaks, but their ability to quote unquote normalize rates, meaning get to back to a period of structurally positive real rates, is almost impossible. And I think that when they are, they're unable to keep tightening into a weakening economy, and the market realizes that, I do think that hard assets are going to have a bid, and especially, ones whose margins are not threatened, right? So in equities, the problem is you have margin pressure. Stagflation environments are not great for many types of stocks because they have margin pressure. Whereas gold and silver, they don't have profit margins, right? They're scarce stores of value. And so that's the type of environment. A stagflation environment is where you generally get the biggest gap in terms of performance between those store of value assets and something that actually has a profit margin. And then you can also lump in things like commodities producers and certain other types of harder assets in the mix of things that I think would do pretty well if they're forced to back off tightening in response to a weakening economy.
Do you have any sort of predictions that you're making for your subscribers about how many more rate hikes are likely before this we go off the rails here?
So I'm looking more at what to watch rather than exactly where it breaks. And so I think what to watch is treasury market and credit market. So a lot of people, they ask the question, how much further down does the S&P 500 have to go before they pivot? And I think that's the wrong question. I think it's what happens with various types of bond markets, especially treasury and credit markets, as well as repo. But I think that's not going to be the issue this time. Basically, all those different financial plumbing things, if you get a freeze in those, they're basically forced to step back, or if you get a prolonged recession. And so currently I'm looking around the end of the year as the time when they might have to either pause or pivot. I know there's some analysts that are predicting even sooner than that, which would not surprise me. I try to, in general, have conservative estimates, and so I think they're going to push as far as they can. And so right now I'm kind of looking at towards the, by the end of the year, I'd be surprised if they're still able to continue hiking into 2023.
What would be like a key threshold you think where the like some economic indicator, would it be like the market having a 20% down day or something really extreme happening that you would think would just change everyone's calculations on what the Fed's policy should be? Would it be like I don't know, some key economic number just being absurdly bad?
I think if you were to start to see persistent increases in unemployment and initial jobless claims, I think those would. If you describe what you just had, if you get what you just described, like a big down day in the market, I think it's one of those things where that would be coincident with something that would freak them out, right? And so,
Yeah.
for example, I think a down move in stocks itself is not sufficient, but if you had an unusually big down gap in stocks, you almost certainly would have problems in credit markets as well. And I think that would be, spreads blowing out, or back in say late 2018, the Powell pivot, everyone looks at the 20% down in the S&P 500, whereas I think the bigger story underneath the surface is that no junk bonds were issued in 6 weeks in the U.S. It's just like the market was closed, and so I think those are the types of things to focus on. But of course, that doesn't happen in a vacuum. The thing we would see when we turn on CNBC or when we look at dashboards, we would see dislocated markets most likely if you start to see freezing credit markets.